Friday, April 8th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Tavi Costa. He's a portfolio manager at Crescat Capital. We've had him on the channel before. It doesn't feel like it, but it was a year ago in April last year that we last spoke. And Tavi, we also spoke in September 2020. And Tavi has had this theme, macro theme, that there's going to be a rebalancing from paper assets to commodities. It has been proven right, in my opinion, especially in the last 12 months. So Tavi, welcome back.
Thanks for having me, Monaco. Looking forward to this.
Me too. So let's start because we don't have that much time. It's a Friday evening and you probably have better things to do than speaking with me anyway.
No, I enjoyed this.
That's good. That's good. So I want to look at the US economy. I know I'm in the UK, but the US economy still affects or reflects what's happening elsewhere in the world. So what's your view of where the US economy is right now? I saw the other day, I think it was yesterday, you tweeted something out or you put it on Instagram about jobless claims because they dropped, I was surprised, to 166,000. I'd never seen a number like that. And you said that that's usually marks a top in the economic cycle.
Yeah, well, usually the economy looks at its strongest levels when you're at the peak of the cycle. Also, we're seeing, major improvements even in non-farm payrolls when it comes to those numbers. The sequence of positive changes is really unparalleled with any other time in history. So at what point most of the good news are behind us? And I think we're very close to that. Looking at the margins of companies, which I think leads to the business cycle as well, we're seeing the ISM manufacturing is starting to roll over. New orders was a chart that I showed the other day on Twitter as well, which was it's been disappointing. And that leads corporate margins, operating margins, to be more specific by about 6 months. And so you would think that energy costs rising and material costs rising, and you have on top of it now wages and salaries, at some point you're going to have some sort of margin squeeze. And I think that's happening already. Then on top of it, you've got the cost of capital rising, which a lot of people didn't believe in it, in that thesis. And now we're seeing 10-year yields rising. We're seeing junk bonds declining. We're seeing the spreads is starting to widen when it comes to what's happening with the corporate bonds relative to even U.S. Treasuries, and so even yield curve inversions in some cases. And so there are quite a lot of signs of we're maybe headed towards either a deceleration of growth or a major downturn. We don't know what's going to be, but there's a lot of ways to position yourself in that sort of setup. Now, knowing we're not going to go to major growth in the next 6 months to 12 months, I think there's quite a lot of things you can extrapolate to position yourself.
Yes, and I wanted to touch upon the Federal Reserve and also maybe the ECB. I saw today that they tweeted out that if there is a problem, if yields start going up too much, that they're going to have some tools to sort that out. And by tools, I guess they mean more QE. That's the only tool they have. So how do you think the Fed do you think they can really do what they're saying, like hike rates, like 50 basis points almost every meeting, cut the balance sheet by 95 billion every month from May? It just seems to me like wishful thinking, because back in the last time they tried that was like 2017, 2018. And by 2019, we had the repo crisis and they had to reverse everything. And it just feels to me that everything is so much more leveraged now. They did so much QE and fiscal stimulus also since 2020 that I don't know what they're playing at. What's your view on that?
Well, I think there's a significant amount of investors conditioned to thinking that we're going to have something similar to what we saw in the last recessions, and I'm feel very strongly this is going to be different, meaning we're going to see something like we saw in the late 60s and early 70s, where a lot of market developments are similar to now. Obviously, the imbalances are much worse today when it comes to the leverage size or just the valuations that we've got. But the inflationary problems is, in my view, even worse than we saw in those during those times. But what am I referring to? I'm referring to, I do think the Fed is in a situation where they have to restore their credibility when it comes to inflation. So I do think they're going to go ahead and raise rates, perhaps even more than what the market thinks. And I'm not betting on that, but I do think there's a possibility of that happening. And in that sense, it's going to come at a cost, and the cost usually is the growth side of it. So it adds to that point of deceleration of growth, or maybe a downturn, which I think there's a big probability of a downturn actually. So remember that during those two times, late 60s and early 70s, we've had 10-year yields actually rising while the market was declining. Or you also saw a Federal Reserve trying to tamp down inflation at a time when you had a bust in the economy. So I think we're going to see something similar. I think we're going to see yields rising, meaning 10-year yields. And I think the Fed wants that to happen. Otherwise, we're going to see yield curve inversions. For the last 3 recessions, every time the Fed attempt any sort of tightening cycle, we've had yield curves inverting after 2 to 3 hikes. And so, is that the case today? I think they're going to try to sell some of their assets in the long end, especially allow 10-year yields to rise in order to restore the credibility. Now, the second question is, do you think it's going to work? And I don't think it's going to work. We're going to reach a level of 10-year yields that's going to be unsustainable. And at some point, they're going to have to do some sort of yield curve control, like you mentioned on ECB. BOJ is ahead of the curve, already announced they're going to be buying JGBs unlimited amounts to cap yields. So that's the world we're going to be in, I think, next, after this attempt to restore inflation, because cost of capital is going to reach a level that is unsustainable. We all know that the debt problem is too high, that the equity markets cannot sustain rates rising to unsustainable levels. The housing market cannot sustain that. So I do think it's going to rise, but there's a point where that's going to turn. And a lot of people ask me, what's that point? I mean, what's the number, the magic number that 10-year yields will start dropping? I don't think you got to guess that. I think all you need to do is to be short treasuries and wait until any Fed members start speaking out about those issues. They're going to be very vocal, as they usually are. And so once they start worrying about issues with 10-year yields being too high, then you start adjusting your portfolio. Then that's not a trade anymore. Then you want to be long gold. You want to be, not that you don't want to be long gold today, but that's when I think gold is going to have its violent move that goes up, to levels that we haven't seen, maybe $3,000 an ounce, and then above that as we go.
Yes, when you look back at the Fed funds rate, like a decades chart, you see that it's come down from, like, it's been on a downward trend since the early 80s. And every time the Fed goes on a hiking spree, it gets the level that it goes up to is lower. And the last time I think was around 2 to 2.5. So I saw a headline or a story on Zero Hedge. I didn't read it, but someone saying that they don't think the Fed can even go above 1% in the Fed funds. So we'll have to wait and see. And I agree with you, when Fed officials start coming out and doing open mouth policy, then we'll have to take note. Before we go into silver and gold and the miners, which is a favorite subject of yours and a lot of my viewers, I wanted to touch upon the narrative. And you've had this, and I've been looking at this as well, even prior to 2020, that we're going to see a rebalancing and a shift from financial or paper assets into hard assets. So where do you think we are in that process right now? And maybe also talk a little bit about Russia and the situation with the ruble, the fact that they're demanding a lot of their non-friendly countries to pay for everything in ruble, and also maybe touch upon Brazil, which is where we're both from, and the fact that the Brazilian currency surprisingly is one of the best performing currencies this year.
Yeah, so a lot of things to unpack. So to start, I think the commodities case relative to financial assets and tangible assets in general, the case back then had nothing to do with predicting a pandemic, predicting an invasion of a country, by Russia, or any sort of issues that we've seen in the past that actually drove commodity prices higher. I think it's impossible to know the triggers, but it's very possible to align the case for commodities that usually happens throughout history. And one of them is the CapEx cycle. It was very clear that we've had a chronic period of underinvestments in natural resources. And when you look at the capital allocation in portfolios in the global stage, we've seen too much money chasing technology and fixed income products, and not too many dollars going after things that will are part of the basic necessities to function the global economy. And so it wasn't clear what was going to be the trigger, but it was very clear that those imbalances are just unsustainable as well. And sometimes those things happen with a drought. Sometimes it causes prices to rise on commodities. Some others have to do with other natural disasters that cause those issues. And folks tend to focus too much on those triggers. But the bigger part is certainly the list of imbalances that have been aggregated over the years that create those inflection points. And certainly what we've seen with Russia and Ukraine was in my view, a tectonic shift in the geopolitical landscape, in the sense of, I think that the protectionist policies gene is out of the bottle. We're going to see a lot more countries worrying about strategic forms of keep their commodities and not allow exports of those. We're going to see issues with logistics and problems with manufacturing products, like we've seen globalization being a trend that allow inflation to be low for so many decades. And that's changing now. So a company in the US that is starting a business today, will they implement a manufacturing plan of closing up a deal in China to work with, have their product being built in China for the next 3 to 5 years, or will they find a way to do that in the US? Those are all questions we need to answer. And I think that the answer is, I don't think they're going to be going to China, implementing those business plans in China as of today. So we may see a net change of that, of companies and businesses coming back to the US. We need to rebuild the manufacturing infrastructure in the US as well. So non-residential building has to increase drastically from here. That's another driver for commodities. And so there are a lot of reasons to believe that inflationary assets are going to continue to perform well and better than others. And, long duration assets, for instance, that I think are the scary ones, technology, even treasury markets and so forth, I think are the ones that you should be a little bit more concerned about. And so Brazilian equities that you asked earlier, I think it's the first time I've seen, Brazil with the macro, the value, and the technical case all align at once. And you have a commodity-driven economy on the cusp of a major breakout. When you look at the charts of EWZ, or which is the Brazilian ETF in dollar terms. And so I think despite all the geopolitical risk in Brazil, and you can size that, the geopolitical issue or the political risk in Brazil is more of a question of sizing, not of a question of if you should make an investment or not. It is not at least yet, it's not a authoritarian regime as we see in other places like Russia and China, which for me, it's uninvestable. I don't think Brazil is in the same category. So we've been chasing some of those assets that generate a lot of free cash flow. And some of them are trading at 3 times free cash flow, 2 times free cash flow, pay dividends, are good assets. They're linked to commodities. And so I don't have much of a view on the currency side, but I do think that those assets could perform very well. So we hedge the currency risk and we buy those assets. And I think it has been doing great. It's not a big position, it's a small position. Every time it declines, we add a little bit. And so, I think it's plausible thesis in the midst of this commodities. I hate to say super cycle, but I think it's a long-term thesis that will play out over the years.
With gold and silver, so let's get to gold and silver. A lot of people had been arguing since last year when the Fed started talking about reversing their monetary policy, that once yields started going up, that it was going to hurt gold and silver, because they think that interest rates going up means lower gold and silver prices. Of course, back in the 70s, that didn't happen. We saw the Fed raising rates, chasing inflation, and gold and silver went up. And lo and behold, so far this year, the 10-year yield started the year at 1.5. And today, as we speak, we reached a 3-year high at 273. I think we were just around 271 at the close of the market here this Friday. And despite that, gold is up over $100 this year. Silver is up slightly. It hasn't done as well. So yeah, what do you think about gold and silver? And after gold and silver, we'll look at some of the miners.
Yeah, well, look, I think what's happening is, and why I think this is more like the 70s when it comes to this correlation between gold and nominal rates, not real rates, is because central banks are being forced right now to also restore the credibility of their own fiat currencies by improving or creating a real anchor, a tangible anchor, when it comes to their monetary system, and something we haven't seen in the past 50 years or so, since the break of the gold standard, where central banks that have the most credible ones are the ones that actually own a lot of debt from the US, right? And so I think that's in the shift. And so that the lack of demand for treasuries that causes the sell-off of treasuries at a time when we're seeing record amounts of issuances of treasuries to drive yields higher, at a time when central banks are actually chasing a tangible asset like gold. So gold should play a big role into this shifts in the monetary system as we go here. So I'm extremely bullish on that. Now, in regards to silver recently, it's interesting because I think most of the gold rally we've seen over this year has a lot more to do with the risk-off driven rally from the war than the monetary side of it. And I think that is one of the reasons why we haven't seen much of that appreciation coming from silver and leadership on silver and the leadership on the miners. But that's changing quickly, as you're seeing. Miners are starting to improve. We're seeing Newmont hitting new highs. We're seeing other miners is starting to improve their performances too. And the juniors are still lagging. So we may see that appreciation too. So silver, in my opinion, it continues to be an inflationary asset. When you look at inflationary decades, silver tends to perform very well. At a time when gold and silver ratio is at about 70, that's very interesting. And you look at silver relative to other assets in different asset classes, such as equity markets, gold itself, commodities, or even indices such as the monetary base or money supply. Silver looks very attractive from all those fronts. And then you've got the green revolution on top of it that should drive some of the demand. So I think there's a lot of reasons to be accumulating assets in that side. I mean, have I been early so far? Yes, I've been early. I mean, it hasn't really hurt us. I mean, it's been kind of going sideways since we're actually, I should say, we really started accumulating assets in 2018. So we're up pretty good on those assets. But other assets have gone up even more. Base metals have performed better. So it's okay. I mean, if the worst case scenario is that the asset went sideways, that's fine. That's not a big deal. But I do think that we're going to see explosive moves to the upside on silver at some point because of the supply and demand profile of the asset and what we've seen as far as data that we can see when it comes to what could drive silver as far as the macro forces that are here in place.
Yes, and in 2020, silver went from like just below 12 during that March crash to almost 30, and it went way ahead of all the general commodities, and the general commodities have caught up and gone even better. And it has been frustrating looking at silver. And I even remember when we spoke in September of 2020, that
Yeah.
at the time you still thought that silver was the most undervalued asset. So I still think it is. And I noticed today that the GDX and GDXJ, they're catching up to like let's say the commodities ETF in terms of year-to-date performance, and junior silver miners, they're catching up as well. And yes, any view on why silver has been like languishing sideways for the last 18 months or so?
Well, it's an interesting thing because it's the same thing we're talking about. Why did I get it right? The commodities or the tangible assets and that rotation out of financial assets into tangible assets when you had all those reasons to own tangible assets and then you got a trigger. But we haven't seen that trigger on silver just yet. And I don't know what's going to be, and nobody knows. But certainly the case has been also accumulating a lot of reasons to own silver. So as a macro investor and value investor, I think you want to look for those situations where you're able to accumulate a thesis or have a very strong case for an asset where you can just, again, be able to build that position over time, until there is that trigger that happens. And I think the trigger could be yield curve control. It could be some dysfunctional thing happen in the monetary system, which already happened, a lot of it. And silver was leading the way before the COVID crash. I mean, silver was doing great. And then after that too, we saw silver coming back strongly right after hitting that 12 handle that you mentioned. I don't know why silver is being so suppressed. I mean, silver is, some folks like to talk about some other issues regarding maybe some sort of manipulation. That's a possibility. But I think if that's the case, then you shouldn't be buying silver in general. I mean, it's if you think it's manipulated, you probably should be buying something else. But I do think there's a bigger case for the asset. And in my view, what I've been doing is I've been looking for primary assets to have silver. And it's very difficult to find exploration assets, even producing assets that are linked to silver in a big way. And I think that our goal has been, let's increase our exposure as much as we can while we haven't seen the move yet. It's okay for, I'm patient.
Yeah,
Other
I think
people are
that's
not
important. Yeah, patience. It's interesting because I spoke with Tom Larson of El Oro Resource
Yeah.
a few weeks ago, and I had spoken to him like 4 years ago, and at the time they're focusing on gold, and he told me he's spoken to you, and they have an interesting exploration project in Bolivia where
Yeah.
they could potentially find a lot of silver.
Yep. Yeah, I mean, he's been on one of the most successful CEOs in our portfolio, I would say, and it's been great to support his story. And the story just keeps getting more and more attractive as they continue to explore. And maybe we're onto something massive. This is Crescat's view.
Yeah.
And it's a polymetallic deposit, which means as other metals outside of silver, tin is a big portion of it. It might be one of the biggest tin discoveries in history. So and so we're very bullish on that name. But there are many others as well that I think fall into the same category. And what a time, be buying those assets and accumulating as much as you can in those assets before the big move. So again, I'm very patient,
Yeah.
and I think it's important to always go back to your thesis, make sure your thesis is still intact, or if anything has changed. If there's no new information that has changed your thesis, then take advantage of the volatility or the lack of volatility in this case, because silver has really gone nowhere in the last few months or so.
Yes, and I guess if people wanted to find out more about what interesting opportunities there are, like in junior silver miners, uh, I guess they can follow you on social media, on Twitter, and on Instagram, right?
Well, I appreciate the opportunity to share that. Yes, I'm not a geologist, but I am an investor in the space, and we hire a geologist, Quentin Henning, which I think is one of the smartest exploration geologists in the world today. And so we've been really supporting most of the stories that he is very involved with and that he likes. And so we created a fund, and he became a partner, and we are managing money with him. And so it's been great, and it's been, the performance has been great, even in this kind of language market for gold and silver. But I think there's a lot more opportunities, really an opportunity of generational wealth being created in this market, as you know very well. And so we've been publishing or posting videos, not as successful as your videos, but I would say we've been sharing some of our presentations on YouTube. If you type Crescat Capital on YouTube, you can find, where we share some of our macro views, and then we go into a story that we've been invested, or a company we've been invested. So a lot of ways you can figure that out in terms of what we're doing, but Crescat Capital is the name of the company.
Great. Tavi, thank you very much for your time. Hopefully we won't wait another year to speak again. And I wish you all the best.
Well, it's always a pleasure talking to you. Thanks for having me. And yes, I hope we can talk sometime soon again.
Great. Thank you. Take care.
Thank you.